Hey everyone, Craig Nickel here from Nickel Buyer Advisory. Welcome to another episode of Property Ponderings. I'm thrilled to share my 15 years of property experience with you, covering anything and everything from investment strategies to renovation tips. Whether you're looking to grow your portfolio or make your first purchase, I'm here to help you make it a success. Today we're diving into the essential steps of planning a successful property investment portfolio. Whether you're just beginning or looking to expand your holdings, each step in this roadmap can guide you toward a resilient, growth-oriented portfolio. One of the core components of working with investors within my business is the strategic planning of investment portfolios to ensure we create a plan to achieve investment goals and how to actually achieve that. Too many people go into investing and property buying in general without thinking of how it fits into their long-term goals and be a life puzzle. So today's episode is going to go over a bit of an overview on how I work through this planning with clients. So the first step is establishing your investment goals. So firstly, we need to define what you're aiming to achieve. Are you looking for long-term capital growth, cash flow, or a blend of both? Having clear, well-defined goals will guide your investment strategy and help you make each acquisition purposefully. As Warren Buffett famously says, an investor should act as though he had a lifetime decision card with just 20 punches on it. Knowing your end goals ensures each property contributes meaningfully to this broader vision. So this first step of establishing your investment goals, just as an example, I've got a hypothetical client named James. He comes to me seeking advice on his investment property. He's unclear about his goals, but mentions he wants good returns. After a deeper conversation, we uncover that his priority is long-term financial independence, with a preference for assets that will appreciate over the next 15 to 20 years. So this aligns with a capital growth focus. We discuss how properties in high demand areas like inner city Melbourne and Sydney could potentially suit this rather than high yield regional properties. And I also explain how each property he buys should meaningfully contribute to his capital growth goal to avoid diluting his long-term vision. So that's just a bit of an example for someone that might be creating some investment goals. The other things to consider are what his plans are with his life in general. Does he have kids? Is he planning to have kids? What's the financial consequences of doing so and allowing for that? Is he also wanting to buy his own family home, or does he already have that in place? And so you can see how many different factors within life and the lifestyle desired impacts the type of investment goals that you want. And more specifically, how much money is James in this scenario wanting for income to supplement his lifestyle down the track? And is there a particular growth of asset portfolio that they're looking to achieve with an exact rental yield? So there's a lot of different parts to planning, as you can imagine, but this is definitely the first step and a really, really important one. Step number 2 is understanding your risk tolerance. So assessing your risk tolerance is the key to aligning your portfolio with your comfort level. As I like to say, it's the sleep at night factor for yourself to ensure that over the long term that the portfolio isn't going to become such a burden that you're so stressed out and it's ruining other parts of your life. High growth investments may carry more risk in this case, while cash flow focused properties tend to offer more stability. So consider both financial and emotional capacity for risk in this step, particularly how you might respond during market downturns. And a really clear understanding of a risk tolerance will help you stick to your plan and avoid impulsive decisions when markets shift. So an example scenario here might be Sarah, a young professional with a steady income. She's eager to invest but has limited savings and is uncertain about handling market volatility. Through a risk assessment, I'm able to help her evaluate how she might react during an economic downturn. I suggest beginning with a more stable cash flow positive or neutral property in a strong rental market to build her confidence. This helps her to ease into property investing while minimizing stress about cash flow fluctuations, allowing her to grow her portfolio without exceeding her risk comfort. And the risk tolerance can definitely change over time, but it is often the case when someone's getting their first mortgage potentially and they're trying to start with an investment that the stress levels can be the highest, especially with minimal experience in using such a large amount of money to purchase an item. It can be overwhelming for some people, so it's an important step here to understand people's risk tolerance. Step number 3 is building a financial strategy. So a strong financial strategy outlines how many properties you'll need, their types, and how they're actually going to be funded. So consulting a financial advisor or mortgage broker can clarify what level of leverage you're comfortable with and determine your ideal loan-to-value ratio. It's important that with the LVR that you end up choosing, that it's supporting both growth and risk management in your overall portfolio. And understanding these financial elements will help you build a portfolio that's both resilient and growth-focused. So an example for building a financial scenario is Mark and Emily. They're a couple in their 40s. They want to retire in 15 years and aim to build a portfolio of income-producing properties. They have a decent amount of equity in their home and are willing to leverage this to fund their investments, but are cautious about high debt levels. So I discussed with them an ideal loan-to-value ratio to maintain growth potential without over-leveraging. So working with a mortgage broker, I'm able to help them create a financial strategy that includes a mix of interest-only and principal and interest loans, allowing them to manage risk while targeting growth. Step number 4 is choosing an investment strategy. So selecting a fitting investment strategy is crucial. In my previous podcast that I released yesterday, I included 7 different investment strategies that could work, and potentially in this step where we're choosing an investment strategy, there could be a bit of a mix that we select as well. Options for that could include buying and holding for capital growth, positive or negative gearing for cash flow management purposes, or potentially development projects. So if you're looking to create value directly, different strategies suit different goals. Negative gearing may suit those focused on long-term growth, while positive gearing is often chosen by investors seeking immediate cash flow. And I'd encourage you to watch that previous episode or listen to that if you haven't yet, as it goes into a little bit more detail just on an overview of the different strategies that you can select. So that would be helpful if you haven't listened to that one yet. But as an example, I might have a client called Alex. He's a high income earner seeking tax benefits. So I discussed strategies like negative gearing to offset his taxable income in conjunction with his accountant while targeting high growth properties. So since Alex is comfortable with longer term appreciation over the immediate cash flow shortage, I could guide him towards established areas with consistent growth records that are going to provide the greatest performance over the long term. By combining negative gearing with capital growth focused investments, I'm helping Alex to manage his tax liability whilst working toward wealth accumulation. Step number 5 is property selection and implementation of the strategy. So it's now actually time to choose the properties that align with the strategy, whether that was to buy and hold. So we're looking for really strong capital growth assets over the longer term. Buying and renovating, we're looking for a property that has the appropriate renovation potential to build out a portfolio. Positive cash flow, we're looking for areas where the rental yield is higher and performing better. So whatever it is that we're trying to target, this is the step where we need to find it and execute on that. Step number 6 is tax and legal structures for the actual purchase. Once you do find that property to add to your portfolio, then it's essential that you go through the tax and legal structures to ensure that optimizing your returns in line with your plan. So the structure you choose to hold each property in can affect tax liabilities and asset protection. Speaking with a property-focused accountant about trust companies or individual options, ownership options can help optimize your portfolio's tax efficiency. So it's of vital importance that you structure your portfolio for asset protection and tax efficiency, particularly to maximize long-term returns and navigate capital gains tax implications if that's a part of the strategy to sell. An example, David, a seasoned investor, is exploring ways to maximise his portfolio's tax efficiency and protect his assets as he's purchasing his fourth, fifth or sixth property, let's say. So after consulting with a property accountant, I discussed the option of holding his investments in a new family trust. This approach not only reduces his tax burden by enabling income distribution, but also provides asset protection. Additionally, you review the potential CGT implications, helping David make informed decisions about structuring his portfolio to optimise returns over time, if a part of that strategy was to potentially sell down a few of the properties. Now, step number 7 is the active portfolio management. So this is after you've purchased the property. So what you need is after the purchase, you need regular active management to basically review each property's performance annually and assess whether it's still aligned with your goals. So if any property is underperforming or the market conditions shift over a longer term and the fundamentals have changed, this is where clients can consider adjusting to these changes. So this might include refinancing, selling, or reinvesting into different markets and property types. Close friends of the show here, mortgage brokers at Hutton Financial, recommend reviewing your property loans every couple of years to ensure that you have competitive interest rates and loan structures to allow for boosting of your cash flows and also long-term returns. So an example here might be Michelle, a long-term client, has built a substantial portfolio over the past decade. Recently, some of her properties have underperformed due to shifts in the local rental market, which have fundamentally changed the quality of those properties. So in this case, I might review her holdings and suggest refinancing options on certain loans to take advantage of some lower interest rates and freeing up cash flow for potential reinvestment into a different market. I might also discuss selling one of the underperforming properties to reallocate those funds towards an emerging growth market if that rare circumstance did occur. Ideally, we often don't want to be selling any properties. This annual review helps Michelle keep her portfolio aligned with her goals and improve overall performance. Step number 8 is sticking to your strategy for the long term. So patience is a fundamental part of building a property investment portfolio. As Morgan Housel says, compounding only works if you can give it time to grow. And the same applies to property. A long-term approach helps you maximize growth whilst riding out market cycles. So we really need to avoid the temptation to sell during downturns if the fundamentals of the property that you've purchased are correct. Often holding through challenging markets does pay off, especially if the property is fundamentally really strong. And patience always allows you to benefit from rental increases over time, which can enhance your cash flow, which is all a part of the plan. An example here might be a client, Tom. He's really anxious about a recent downturn, is considering selling one of his properties to avoid further potential losses. So I review the property's fundamentals with him, including its location, rental demand, and explain how these factors support long-term appreciation. So by discussing the benefits of a long-term strategy that we have put in place and showing how his property still aligns with his goals, I will keep him on course and prevent him from making a hasty decision that could cost him his future growth and the achievement of the plan that we set in place. Of course, there could be changes, like we've just mentioned, that could occur, which may mean a change in tact and direction would be more beneficial, but that would be very rare, as most of the properties that are purchased, the fundamentals don't just change overnight or in a short period. It tends to be a very long and patient game, as I'm trying to impress onto you, is that patience is really important, and often the fundamentals don't change. It's just that the current circumstances are showing some negative sentiment that just needs to be ridden through if possible. And the other important thing here is that as you're riding through these changes, there are other factors. So if there's financial issues where you are really struggling to pay for something, that's a different issue from just someone that's thinking about selling because the market's not very good. Step number 9 is to enjoy the rewards of the great investment portfolio. So after completing all the other steps and after years of planning, hard work and disciplined management, the final step is to enjoy the rewards. And so a well-structured portfolio not only provides financial independence, but also gives you the freedom to achieve broader lifestyle goals. So you've built that portfolio that works for you, offering both wealth and security for the long term. So this is often a person or a couple that has had 20 years of disciplined investing at least, and they've reached their retirement goals. So their portfolio now generates enough rental income to support their desired lifestyle without requiring them to dip into their superannuation and all of that. So there are many different scenarios that could play out when you do get to this step, but that's just a quick example. So that wraps up another episode of Property Ponderings. I hope this has given you some valuable insights into planning a successful investment portfolio and left you feeling equipped to make some strategic and informed choices. If you'd like to discuss anything further from today's podcast, or if you're looking for some tailored buying and renovating or property investment strategy planning advice here, then please feel free to reach out on 0400 122 081, or you can email me at craig@nickelbuyeradvisory.com.au. We'll chat again soon. Information provided in this podcast for general information purposes only and does not constitute financial, legal or professional advice. While we aim to provide accurate and up-to-date information, every property transaction and investment is unique and should seek the advice of a qualified professional before making any financial decisions. The opinions expressed in this podcast are our own and are not a substitute for tailored advice from a financial advisor or a real estate professional. We encourage you to consult a qualified expert in your personal specific needs and circumstances.